Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and wanted to bring you another little insight into another way that we may be seeing some lower mortgage rates here really soon, and that is through the Treasury Department. Yes, the Treasury Department. So it's got to do with some regulations that were put on back during the crash of 2008, and let's take a look here at what that entails. So, the Trump administration prepares to ease banking rules. Basically, what this is, in a nutshell, to keep it short and sweet here, is they're going to be. There were some rules put in place during the last crash that the banks had to have a certain amount of funds available in reserves. They're basically going to be easing that or taking that away. So, what Scott is saying here is it could basically, we're pushing to have the supplemental leverage ratio, that's what it's called, the SLRs, supplementary leverage ratio, either reduced or removed, and it will allow banks to buy more treasuries. Bessent said in a radio interview with Roger Stone last week, adding that it will help deliver on his goal of lowering interest rates. So this is just another tactic while the Fed is being slow to the game again. They should have already lowered rates. It should, be 100 basis points lower right now in the Fed's fund rate, and that affects about 65 to 75% as far as the mortgage rates are concerned. This should help with lowering interest rates. He said easing the rule could reduce Treasury yields by 0.3 to 0.6 percentage points over time. Okay, so basically, this will get rid of these regulations, and I'm just going to just jump right over here so you can hear right from what he's got to say here in this short clip.
One form of regulation that gets a lot of attention in New York and on Wall Street is banking regulation. Let's talk about the supplemental leverage ratio, which seems like an obscure thing off to the side, but it has been the subject of much discussion. And it does, as I understand it, relate to US Treasuries and yields on US Treasuries, so that if major banks held more US Treasuries, it would bring yields down. You've said you're going to take more of an active role, as I understand it, with respect to some of that banking regulation. Where are we with that?
I think we are very close to moving the supplementary leverage ratio, SLR. That is moving along very quickly between the three banking regulators, the Fed, the OCC, and the FDIC. So I would think we could see something on that over the summer.
Over the summer, and knowing the markets as you do, would you anticipate that might have a significant material effect on Treasury yields?
Well, I think it could, because banks are being penalized for holding treasuries. There's a large supplementary leverage charge. So I think for holding the risk-free asset, we can reduce that. And I've seen estimates that it could bring yields down by tens of basis points. Certainly during the COVID crisis, it was the temporarily taken off, and it had a big effect.
Okay, so